Good morning, traders. It's Monday, January 5th. Hopefully everyone had a great weekend. I am back from warm tropical Florida, back to snow-covered. I'll show you two extreme photos at the end, or video clips. But anyways, let's dive into the charts. Kicking off the first kind of full trading week here of the year. It's going to be interesting to see how the markets unfold. Now, last week we saw the market sell off. We got into a short-term oversold territory. On the 30-minute chart, we also saw a little bit of panic selling, which carried over into the final trading session. When we look at the daily chart, we've had a series of, let me grab a pencil here. We have had a rally, a pullback, a rally, a pullback. It is trying to figure out if we are going to get traction here and push and extend that 3 to 4.5% to the upside based on Fibonacci patterns here, which short term, we can look at this high and this high. That gives us a upside target of around 7,085. Of course, we could look at a bigger one if the market was to have this bigger pullback, or sorry, this bigger rally. It points to a little bit higher pricing to the upside. So we'll see how this market unfolds. It's trying to figure out if we're going to get some traction. Generally, we see the first week and a half, 2 weeks of January with a little bit of a bounce. Probably people rebuying, re-entering the positions they potentially sold at the end of the year to get back in for tax loss harvesting, whatever they want to do here. Today we are seeing money flow into stocks. We're seeing the equities market up 0.25%, Nasdaq's up 0.7%. We also have the Russell up and the Dow is flat. Now we do have the dollar posting a pretty big move to the upside. It's starting to hook and pop, and this is what we've been talking about, how the dollar has been moving down, carving out this here is a bottoming type of pattern. The way that this moves is a signature sentiment move. It's just the way, typically how bottoms form and how people get out of positions. And hopefully we'll see this traction start to take off. Now, I talked about how the dollar could move sideways or trade higher, and gold and silver and miners could, all continue to rally at the same time. And we're definitely seeing that today. The dollar is almost up 0.5%. Gold is up over 2%, which is a nice pop and a nice bounce. We've got silver up nearly 6%. And we've got platinum and palladium. When we look at all these, silver, this high momentum pattern here, if it obviously has lots of volatility, but if it gets traction, this thing could really explode to the upside. In fact, we could take a conservative play right here and here and here for silver, and that gives us an upside target. Let's just full screen this, make it a little bigger here. It gives us an upside target of 95. Now we could even go all the way down to this pivot low here, which is kind of where this last rally went. Obviously, that puts us up at 104. We could even go to this previous one, which puts us at 106. So we talked about 68 being a resistance level, then 82, which we pretty much tagged 82 and then selling hit. And now we're getting this big pause in consolidation, and now we've got potential for this explosive bubble phase where things go absolutely ballistic. And so we just have to let this market mature. Are we going to see this final wave where precious metals really take off? It would be pretty exciting. I mean, most of us have precious metals, and it's this big push to the upside will definitely move the needle for a lot of people's portfolios, which is pretty exciting, and why we own it, why we follow it with our strategies. Anyways, take a look at, let's move over to oil real quick. Energies. Oil had a sell-off this morning. It found some traction. You can see on the 10-minute chart at the bottom, it sold off overnight, had a sharp drop with some big selling, and then it's kind of ripped to the upside. Well, I'm not sure if there was some news there, but it's trying to figure out what it wants to do. In the big picture here, it is obviously still trending down and testing these lows around that 55, 56, which potentially could be broken sooner than later. If we take a look at Bitcoin, let's take a look at platinum and palladium real quick, just because I know a lot of people are involved in these. We've got obviously very big volatility. I prefer gold and silver at this point over platinum and palladium. To me, they're just uglier charts, more volatile, and I just don't trust them as much as a signal for gold and silver. Palladium, also very similar, big reversal bar, a lot of damage done. They could all pop and really explode to the upside as well. It's just I don't know them as well. I don't know the characteristics. I don't know the individuals who trade them as much. I have a very good feel and understanding of gold and silver traders. Platinum and palladium is usually the same group of people, but there's a bit different mindset and a different kind of type of momentum that moves in there. And every asset has its kind of characteristic. And platinum and palladium really come to life during some unique scenarios, and that's kind of where we're at. Again, I always like to focus on trade what you know, trade what you understand, and you have a good feel for. You don't need to branch out and trade other things just because they're moving. I'd much rather trade something I know and make a little less and be comfortable than to jump all around and try and chase money in things that are more volatile and really just come to life for short stints and can reverse very quickly. And just a reminder, it's been on my mind here, 43.8% of you that watch my analysis here haven't yet subscribed to my channel. So if I could ask you a favor to help out, if you like the content I share and you want to support the channel for free, a simple way to do this is to just hit the subscribe button and follow what we do and what I share here. My commitment to you is to try to put out more content that's educational, that's actionable. I do read your feedback and I share topics, and I'll cover more topics from what you guys want me to share and teach in these videos. So please subscribe if you like what I do here and share it. And thanks so much. Let's take a look over at Bitcoin, up 3% this morning. Again, it's been treading water for a while, this big sell-off. This could be a big bear flag. If we zoom out on the chart, there could be a point here where, oh no, my chart's messed up here. There could be a point where we see Bitcoin potentially move higher. If the stock market has a bounce, it could put in, you could say, a head and shoulders formation. There could be a neckline across here. If and when it breaks down, it'll be a fairly precipitous fall to 60 or 50K most likely. But at this point, it is still in this somewhat bearish formation. The short-term chart clearly to the downside. It's in a bearish formation. When we zoom out on the longer term, though, obviously the long-term trend is still up. We got kind of these cycle lows that happen repeatedly, and technically it is on a longer-term cycle low, which is why we could get a bounce here. And the question is it just a bounce that runs out of steam and it sells off with the stock market, the economy, or is it going to want to push up and go higher? We'll just have to wait and see how that unfolds. Now, I just want to touch on a quick question. I know a member, I made a comment in our last video saying how most of us hold real estate. And I talked about IYR, which is the real estate ETF. And he said, what strategy do we own real estate in? And I just want to clarify that. Sometimes I might not be crystal clear, but most of us as investors as a whole, if we're investing in the stock market, we probably own our own house. We might have rental properties. We might have a business and a business property, commercial or industrial. So that's what I'm talking about. I'm not talking about most of us have IYR or a REIT ETF. I'm talking about most of us own real estate, and it's important to understand the cycle of real estate. And the REITs, I was talking about how we could see a very big correction, and it could become an opportunity. I do like real estate a lot. I want to buy some physical real estate when the time comes, but you can see real estate REITs can fall 42%, which is unheard of in the physical market. You don't really hear real estate too often dropping 40, 50%. I mean, in 2007, 2008, or 2008, 2009, we did see that. You can see here, these REITs can sell off quite dramatically and become a huge opportunity. And what I like about the REITs, when the time comes, now I think we're still probably a year or three away, maybe, depending on how precipitous the market rolls over and when it rolls over. But REITs are a great way to get involved if you don't have real estate or you want more real estate, because you can buy them with $10,000, $5,000, $100,000. You don't need to put down 20% and get a mortgage and do all that stuff. You simply move into a REIT, into a space that you like, that pays these purple lines across the bottom. These are all dividend payments. Pays out 54 cents, 71 cents, like every month or every quarter, depending on the REIT. They'll pay out all the rental income, the growth, the interest, and the earnings. So it's a great opportunity when the time comes to get in. And not only will you make probably 8, 10, 15% return on on the dividends. Like if you buy them low, the dividends should be fairly high. But as price goes up, you make money on the growth of the ETF, which is generally fairly big. As you can see, if you were to get somewhere in the bottoming phase, and there's hundreds of percent upside. But also, as you get up into this upper level, the dividends are usually they keep going up. They get higher and higher, and you've paid a lower price. So your dividend income when you buy a REIT low can definitely be over that 10% mark each year very easily. So that's what I'm talking about when I say most of us own real estate. If you're invested in the market, you generally have a home, and it's important to understand we could see a very precipitous fall in this space at some point, and it becomes an opportunity. And just to be mentally prepared, your home value that you're in might drop 20, 30, 40% over the next few years. And that's okay if you live in it. Real estate is a long-term play, but you definitely, I don't think, want to still be buying real estate up here. Anyway, let's dive into... Let's take a look at the bond market. We'll just go back. If we take a look where we're at, this is a pretty significant pivot zone on the bond chart. This is long-term bonds. You can see back to early 2000s, it traded through here for a decade, and then it kept pushing up. We had the COVID spike, which we ended up getting out literally right at the high with our strategy with the 19% gain. Since then, it's been in this bearish phase, and it is doing what the dollar index is doing. I talked about earlier. This is a signature bottoming type of formation. This is a sentiment. This is the way these move. If you notice, they're fairly similar, and they usually are saying that, okay, we're in that final stage, a bottom, a base is starting to be formed. Overall, looks like this is similar to the dollar in terms of, I think they're going to eventually want to go higher, and bonds, I think, are going to become a good play at some point, but they're still in a stage one base. They're at long-term support when we zoom out. We just want to let this thing continue to work itself out. But overall, bonds are starting to try to build a base. Unless something really falls apart, I don't see bonds going off a cliff and going lower, but you never know. You cannot trust these markets or where something could go. This could end up being a bear flag, and we see for some reason bonds go even lower. So don't try to pick a bottom. Wait for it to turn the corner. Wait for it to turn up, and then we can look at taking advantage of bonds. And that'll be a very powerful play for us, actually, when we're not in the equities markets. And I think we could see the bond stock market relationship start to come more back to life, whereas stocks down, bonds up type of thing for a window at a time.